Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq, with daily insight on the Nasdaq 100 index, or the NDX, which is made up of 100 of the largest domestic and international non-financial innovative companies listed on Nasdaq. The NDX has been the barometer for U.S. large cap growth and also one of the best performing indexes over the last decade and a half, not to mention one of the most liquid index ecosystems in the world. Joining me this Tuesday afternoon, we have Shawn, Cruz, manager of trader services at TD Ameritrade, to discuss Nasdaq 100 performance, trends in the Nasdaq volatility index, or what we call VOLQ. Of course, we're also going to tackle inflation as the key CPI data comes out on Thursday morning. Shawn, it's great to see you as always. Welcome back to Trade Talks. And, if we just isolate yesterday's session and today's session alone, the magnitude of the swings, it's really hard to wrap your head around that kind of velocity when you're seeing multiple percentage moves just on the intraday.
Yeah, and I wanted to put the chart of the Nasdaq 100 up against the chart of VOLQ, which is an implied volatility measure for the Nasdaq 100. And when you start to see VOLQ pull back towards that 30 level and below, I think that's where you start to see a shift in overall sentiment, where you do get a lot more buyers coming into the market. But if you start to look at when do we start to see that pullback, if you look and just take a look at the ranges, they usually start to tighten up. We usually see a little bit of consolidation before we get any sort of a pullback. So that's what I'd be looking for now. But you're correct. In the past couple of days, when you continually see these massive long candles and we're going down and testing some of those extreme lows, that tells you that the market is still getting caught off guard on certain days. So right now, I'm just looking for any sort of a consolidation, looking for those daily ranges to get smaller and smaller, because that's the sort of stability you need on the historical volatility front before you get that comfort with more buyers coming back in. Definitely need to get a base established.
Yeah, that's a great point that you make, Shawn, especially when we've gotten so used to this buy the dip mentality and not really having prolonged periods of volatility in the market. That's a great point that you make. It's just not snapping back as quick as it was like we saw in the past couple of years. I know you're also taking a look at interest rates, of course. So what are you seeing with the 10-year and the 2-year? Because if we're getting the moves in the equities, we're also going to be getting moves on the fixed income side.
Yeah, and I think what you're looking at is, one, when you see the 10-2-year spread, a lot of people like to track that and get a sense for what the sort of growth and how much optimism for the general economy is being priced in by what we see in the treasury markets. And so when you start to see that coming down, it's not a very good sign. You certainly don't want to see that go negative, because that usually means the market is pricing in the potential and a strong potential for some sort of negative economic growth in the future. And right now, I really think it's an extension of some of the inflationary pressures we're seeing that are just absolutely widespread. They're not just focused on crude oil or gas markets. It's getting into commodities. On the agricultural side, it's getting into commodities and the metals. It is just getting so widespread and becoming so much more entrenched. There is a genuine concern that there could be a little bit of an impact on economic growth as a result of this. And if you look at what's going on with inflation expectations, you've seen those continue to climb. And it's a sort of a well-known phenomenon in economics. The best predictor of inflation changes are going to be perceptions for future inflation changes. It almost becomes self-fulfilling, and it looks like that's what we're seeing here now.
Yeah, and let's talk more about that inflation, Shawn. Just reading a report that came out a little bit earlier this afternoon that regular grade gas prices reached 4.17, right? $4.17 on Tuesday. That is a 55-cent increase from a week ago, right? So when we look at this CPI data, the two things that come to mind, it's always going to be prices at the pump, and it's always going to be what it costs to put food on the table. And that 55-cent increase in just a week probably does not bode well for the CPI data on Thursday.
I think so. And I think if you're looking at market reaction, or why that might be a little bit concerning, think about what that means for households that we want to be out there actively participating in the economy via spending. When you're starting to see that show up at some of those, I call them the core goods, because they're the things you can't go without. I know when we think of core CPI, we think X food and energy, but that really is at the core of everyone's spending budget. And when you're seeing these kind of massive spikes in those items, it becomes a little bit more troubling. I think what we saw driving some of that CPI growth over the past year or so were things that everyone could could be okay with or could write off as it's just transitory. I don't have to go out there and buy that used car. I don't have to go out there and buy that luxury good, whatever it may be. But now that it's really starting to hit home to those things you need every day, especially if you're someone who wants to go to work, it's getting expensive just to fill up the gas tank on a week-to-week basis, getting to work. But certainly in the food front, that's why I think it's worth pointing out, when you look at these commodity prices, and it's not just a few spots here and there, it is across the board. That is going to make its way down to those actual prices you're paying. We're seeing it on gas, but you're probably going to start seeing it get even more pronounced in other areas if we don't get some of these prices to come down soon.
And Shawn, just to take that a step further, I wonder how that's going to start to impact perhaps employment, right? We know that higher commodity costs, we know higher prices at the pump disproportionately impacts people who work in the services sectors that have to drive to their job. They don't have the luxury like you and I to work from home 3-4 days a week, go into the office 1-2 days a week, and you and I are connected to mass transit. So we don't think of it in those terms, but this is going to disproportionately impact lower income earners, where it might not make economic sense to go back to work. And this kind of gets us back to where we were with COVID and figuring out childcare and what's cost effective to go back into the workplace or not.
It is, and I think, yeah, once you start wrapping in a trip to drop your child off somewhere, on top of that, you're doing a lot of driving just to get to your workplace every morning. So I think you're going to see an adjustment likely would have to at some point come from the actual wages that are being paid, which will show up as an expense for a lot of these companies. We've already seen that show up for a lot of businesses that have already had to go out there and hike wages to offset the higher cost of living. But I think it's really accelerated recently. And if it does get more entrenched, then you'll start to see that show up in the form of wages. And wage increases aren't something you can just take back. Hey, I paid you $15 an hour last year. Prices have moderated, you're only getting $13 this year, $14 an hour this year. You can't do that. Those get sticky and they stay elevated. So that's where those things become much more entrenched, and that could just have a general effect of increasing cost across the board in the economy. When you even see something like wages start to rise, there's a follow-on effect from that. So it's certainly going to be something that the market, the longer this effect lingers, the longer it hangs, the more it is going to be a big driver of volatility and uncertainty, if not just at the macroeconomic level, but also for these businesses in terms of costs.
All right, Shawn, we appreciate your chart work and insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.